Okay, today I want to show you that quantitative easing is the same thing as debt cancellation, and to tell you that the implications of that are very, very important. When a central bank buys the government's debt, it's the same thing as canceling that debt, although very few people dare recognize this fact. The government pays interest on its bonds to the central bank, and then the central bank returns to the government the profits it earns from that interest income. That means the bonds have, in effect, been canceled, unless the central bank actually sells the bonds back to the public one day. And I don't believe they will ever do that. So technically then, perhaps we should say that QE is debt suspension. I believe this suspended debt can be, should be, and eventually will be canceled. But regardless of whether it remains permanently suspended or actually canceled, this reality of trillions of dollars of debt with no cost has enormous implications. Governments have much less debt than is generally understood, and that means they could spend more and finally end this global economic crisis. When the Fed makes a profit, it gives it to the government. It's given the US government $500 billion since 2008. Here you can see how much the Fed has given the government each year back to 2005. Last year it was $99 billion. The Fed remitted $99 billion to the Treasury in 2014. That amount was equivalent to 20% of the government's budget deficit that year. So without that remittance, the budget deficit would have been $600 billion instead of $500 billion. So here's how it works. The Fed creates money and buys government bonds. The US Treasury Department pays interest on those bonds to the Fed. The Fed then turns around and gives almost all of its profits to the Treasury, including the interest income it earns on the government bonds it owns. That means the Treasury is not really paying interest on those bonds. In other words, the government bonds owned by the Fed have effectively been canceled. Okay, so let's start by looking at the way things worked before the crisis. A significant amount of government debt was already effectively canceled through seniorage, and this involves currency creation. So here we have a statement from the Federal Reserve Bank of New York, how currency gets into circulation. There's about $1.2 trillion of US currency in circulation as of July 2013. The Federal Reserve banks distribute new currency for the US Treasury Department, which prints it. Depository institutions, in other words banks, buy currency from the Fed the depository institutions, the banks, buy currency from the Federal Reserve banks when they need currency to meet customers' demands. So the Fed sells the banks currency, and in exchange the Fed obtains cash, and the Fed takes that cash and buys government bonds. Here you can see the currency outside banks. In other words, these are dollars in circulation, or technically Federal Reserve notes, up to 2007, when there were $774 billion of notes in circulation. So the Fed sells these notes to the banks, it obtains cash, and it takes the cash and buys Treasury bonds, which is what you can see here. The blue line is Treasury bonds owned by the Fed. So the Fed earns interest on the Treasury bonds it accumulates, and then it pays that interest back to the Treasury Department. In other words, the bonds the Fed accumulates by printing money are effectively canceled, roughly $775 billion worth at the end of 2007. So when a government can create a currency and sell it for more than it costs to create, the profits are known as seigniorage. And what I've just described is a form of seigniorage. Okay, so I know this is too small for you to read, but I will tell you the important items here. This is the Federal Reserve Bank's consolidated balance sheet on this side, and this is the Federal Reserve Bank's combined income statement on this side. So the Fed total assets amount to $915 billion, and most of those assets are comprised of U.S. government securities that it owns, $750 billion. On the liability side, now this is all as of 2007, on the liability side, the main liability was the Federal Reserve notes, or the currency in circulation, of $790 billion. Okay, so the government earns interest on these bonds that it owns, but it doesn't pay any interest on these dollar bills that it issues. So let's look at the income statement. Well, interest income on government securities was $40 billion in 2007. The Fed earned $40 billion on the Treasury bonds it owns. But it paid very little interest. And so it ended up with net income of $39 billion. And of that, it paid $35 billion to the Treasury Department. Okay, so once the crisis began, things became a little more complicated. This shows currency outside the banks again. This was 2007. It's now gone up to 1.2 trillion. So the Fed sold these dollars to the banks, obtained cash, and bought Treasury bonds with them. It now owns, as a result of this, $1.2 trillion of Treasury bonds. That represents about 7% of all U.S. government debt, which has thus effectively been canceled. But that's not all. Here you can see, and this is up to this week, currency in circulation is now 1.3 trillion. So the Fed would have accumulated $1.3 trillion of Treasury bonds that way. But when the crisis started, the Fed started printing even more money and using it to buy even more Treasury bonds. So now the Fed owns $2.5 trillion of Treasury bonds. That's 1.2 trillion more than it would have owned had it just stuck with issuing the currency and buying Treasury bonds that way. So now the Fed has nearly $2.5 trillion of Treasury securities, or nearly 15% of all U.S. government debt. It receives interest on those bonds from the Treasury, and then it pays the interest back to the Treasury. So as long as the Fed does not sell those bonds, and as long as it keeps rolling them over every year when they mature, then those bonds have been effectively canceled. And there's still more. Okay, same chart, one more line. This time the green line represents the mortgage-backed securities backed by Fannie Mae and Freddie Mac, the government-sponsored enterprises. And the Fed has bought now $1.8 trillion of those. So the Fed owns, in addition, $1.8 trillion of these GSE-backed bonds. And the Fed receives interest on those bonds from the GSEs. And then the Fed gives the interest to the Treasury Department, thereby reducing the government's budget deficit by that amount. The Fed will continue earning interest and giving it to the Treasury, and thereby reducing the budget deficit every year, so long as it does not sell those GSE-backed bonds, and so long as it rolls them over when they mature. Okay, so every balance sheet has to balance, but here you can see the Fed's assets, the Treasury securities it owns and the GSE-backed bonds it owns. These assets are much larger than this liability, the currency in circulation. So what are the other liabilities on the Fed's balance sheet? Well, the other liabilities are deposits held at the Fed by the banks. These are called bank reserves. and you can see them here. The Fed now has $2.6 trillion of deposits, bank deposits, placed at the Fed, in addition to the $1.3 trillion it has of currency in circulation. So the definition of base money is currency in circulation, this, plus bank reserves held at the Fed as deposits, this. So it's easy to understand how this currency is money, but this is also money. It's money deposited in the Fed as bank account deposits. So these two combined make up total base money. All right, the Fed doesn't pay any interest on the currency that it issues, and it only pays 25 basis points interest a year on these bank deposits held at the Fed. Okay, so now you can see the assets of the Fed, the Treasury bonds it holds and the GSE-backed bonds that it holds. These are assets, and these are liabilities, the currency and the deposits the banks have placed at the Fed. In other words, the base money. The assets and the liabilities roughly match each other. Now, this is a screenshot of the Fed's balance sheet, the asset side, and this was as of last week. In total, the Fed has $4.5 trillion of assets. The largest asset is the U.S. Treasury securities, $2.5 trillion, and the next largest asset is this $1.7 trillion, which are the deposits held at the Fed by the banks. Now let's look at the liability side of the balance sheet, and here you can see that the Fed has $1.3 trillion of currency in issue. That's considered a liability, and $2.6 trillion of deposits held by the depository institutions at the banks. So I misspoke. So back here on the asset side, you have the Treasury securities and the mortgage-backed securities backed by Fannie Mae and Freddie Mac. Those are the assets. And on the liability side, you have the currency in circulation and the deposits held at the Fed by the banks, $2.6 trillion. So those are the liabilities. The Fed pays no interest on these, and it pays 25 basis points on these. Okay, so let's look now at the income statement of the Fed. This was for 2013, the most recent year available. And what you can see here is the Fed earned $52 billion interest income on the Treasury bonds that it owns, and it earned $37 billion on the GSE-backed mortgage-backed securities that it owned. And that generated a lot of interest income and total interest income, here, $90 billion. But it didn't pay very much interest because it doesn't pay anything on the currency that it issues, and it only pays 25 basis points on the bank deposits. So that only amounted to $5 billion in interest income here. So the Fed ended up with net interest income of $85 billion in 2013. And this is another way of looking at their income statement. In 2013, they had a lot of interest income and very little interest expense. So the current net income in total was $82 billion. And out of this $82 billion, they gave $80 billion to the Treasury Department. Earnings, remittances to the Treasury. $80 billion they gave to the Treasury in 2013, $88 billion in 2012, and in 2014, the Fed gave the Treasury $99 billion. Okay, so here you can see the Fed's total assets. And what this represents is the amount of fiat money the U.S. central bank has created. Now, this has increased very radically since the crisis started, up very, very sharply. The Fed has created $3.5 trillion fiat dollars. Now, according to all theory and textbooks, this kind of paper money creation by a central bank should very quickly lead to very high rates of inflation. or even hyperinflation. But it hasn't. The United States and the world is now confronted with the threat of serious disinflation and even deflation. So why has there been no inflation? Fiat money creation on the current vast scale has only been possible because of globalization. Globalization is very deflationary because it's caused a collapse in the marginal cost of labor. Now, what I mean by that is that you don't have to pay anyone $200 a day in Michigan anymore to build an automobile. Instead, you can pay someone $10 a day in some developing country. So the cost of your next worker has fallen by 90%, putting extreme downward pressure on wages. And nothing like this has ever occurred before. It's extremely deflationary, and it's offsetting all of the inflationary consequences of the paper money creation. So without globalization, so much fiat money creation would have caused very high rates of inflation or even hyperinflation. But the combination of globalization and fiat money, this creates an unprecedented opportunity to support economic growth with both fiscal and monetary stimulus. So here's how globalization makes quantitative easing possible. Under the Bretton Woods system, or the gold standard that preceded it, trade between nations had to balance. So economies were national economies. Now, well, when we no longer have a national economy in the United States. When we did, trade had to balance. But when we had national economies up until around 1980 in the United States, printing so much money would have quickly overstimulated the economy and led to full employment and full capacity utilization in industry. And that would have caused inflation, wage push inflation. So QE was not possible then. But now, under the dollar standard, trade no longer has to balance. And the United States runs very, very large trade deficits every year. So when the US economy is strong, the United States buys more from other countries. So the US is no longer constrained by domestic bottlenecks. We now have a global economy with 7 billion people, 2 billion of whom live on less than $2 a day. That means we won't hit full labor capacity or have wage inflation for decades. We also have excess industrial capacity across almost every industry globally. And that also puts downward pressure on the price of industrial goods. So that's why we can print money without causing inflation. In fact, that's why we will have deflation if we don't print money. So the combination of fiat money and globalization has never occurred at the same time before. That means we can print money without causing inflation. This is a once-in-history opportunity, and the developed economies should take advantage of it. The government debt held by the central banks should be permanently suspended, perpetually rolled over, in other words, canceled. Then it would be clear that governments really have less debt than is generally understood. And that would mean the governments could spend more to end the global economic crisis. Governments should borrow more and invest that money in new industries and new technologies to restructure the economy and to retrain and educate the workforce at the postgraduate level to ensure that the standard of living in the developed world continues to improve instead of sinking down to third world levels. This could be financed by fiat money creation, quantitative easing. The Fed, until recently, printed $85 billion a month. Think about what could be achieved by investing $85 billion a month over just 1 year. For instance, think GQE, green quantitative easing. quantitative easing to finance investments in green technologies. $85 billion would go a very long way. The next month, an $85 billion investment in genetic engineering, and then an $85 billion investment in nanotechnology, $85 billion investment in nanotechnology, and so on, and so on. Now, I've written about this in my last two books, so I'm not going to elaborate it on much further here, other than just to say that I know many people think that the government can't do anything right and that any investment would be entirely wasted. But that's just absolutely wrong on so many levels. Just to give you one example, you wouldn't be watching this video on the internet had the government not invested in the internet and created it. There would not have been an internet otherwise. So the government can invest wisely, and it should invest more. It has an enormous, tremendous opportunity to do so now, and it should take advantage of it. All right, so let me begin to wrap this up. When a central bank prints money and buys its government's bonds, that's the same thing as canceling the government's debt. The central bank is part of the government, in reality, if not exactly in theory. You can't owe money to yourself. Neither can a government owe money to itself. The government pays interest on its bonds to the central bank, then the central bank returns all its profits to the government at the end of every year. That means the government does not pay any interest on those bonds. Or more precisely, it pays interest to itself. Therefore, quantitative easing is debt cancellation. The central bank should announce that they will hold government bonds they now own forever and roll them over forever. They don't have to actually write them off, but that would have the same effect as writing them off. Then the government's debt level should be recalculated with the central bank's debt holdings deducted. This all means the governments can borrow more. If they borrow and invest, then the crisis of the declining middle class would be over. So what are the implications of this for the United States? The Fed has acquired $2.5 trillion of U.S. government debt, or nearly 15% of the total. That means the ratio of U.S. government debt to GDP is not 105% as it's reported to be. It's actually 91%. In addition, the Fed has acquired $1.7 trillion of GSE-backed mortgage-backed securities. In 2013, that generated $37 billion of interest income that the Fed paid to the Treasury, reducing the budget deficit by $37 billion, or by about 5% that year. Last year, income from those bonds may have reduced the budget deficit by as much as 10%, since the interest income was higher and the deficit was lower. This will continue to generate deficit-reducing income every year as long as the Fed continues to own those bonds. Now, Japan. The Bank of Japan has acquired approximately 250 trillion yen of Japanese government bonds, or roughly 22% of the total. That means Japanese government debt is not 245% of GDP, as it's reported to be, but 223%. The BOJ intends to continue buying 80 trillion yen worth of government bonds every year, and that's more than twice the amount that the budget deficit is projected to be for the next few years. So the BOJ-owned share of government debt will continue to increase. Now the Bank of Japan seems to understand that quantitative easing is debt cancellation, and so they're pursuing it very aggressively, because this may be the only way for Japan to avoid a government debt crisis. If interest rates go up significantly in Japan, it will cause a fiscal crisis unless the BOJ has acquired a large part of the government debt. That's because if interest rates go up, the government will still have to pay more interest on those bonds held by the BOJ, but the BOJ will turn around and give all that interest income back to the government. In that way, higher interest rates would not cause a fiscal crisis in Japan. So the higher the proportion of government debt held by the BOJ, the less the chance of a fiscal crisis. Now the UK. The Bank of England has acquired £375 billion of UK government debt. That's 26% of total UK government debt. That means the ratio of government debt to GDP is not 84%, it's 58%. Therefore, the case in favor of growth-retarding austerity is even weaker than it appears to be on the surface. The UK Office of National Statistics tells us that during the financial year 2013-2014, £31 billion was transferred from the BOE to the government. Of that amount, $12 billion impacted on net borrowing. Net borrowing was £107 billion that year. So in other words, what that means is that the interest income on this £375 billion roughly reduced the UK budget deficit that year by 10%, roughly 10%. And the income from the QE bonds will continue to reduce the UK budget deficit every year, so long as the BOE continues not to sell those bonds and continues to roll them over as they mature. Now, the eurozone. The ECB plans to buy 1.1 trillion euros worth of government and private sector bonds between now and September 2016. That's roughly equal to 10% of the eurozone government's debt at the end of 2014. So let's assume the ECB will buy 800 billion of government debt and 300 billion of private sector debt for 1.1 trillion in total. Its purchase of 800 billion euros worth of government debt will be almost twice as large as the eurozone government's combined budget deficits for the next 2 years. Those deficits are estimated to be about 440 billion for 2 years in total. In other words, it will finance and cancel the budget deficit for 2015 and 2016, with 360 billion euros left over, which will be used to acquire and cancel government debt that had been issued in earlier years. The additional acquisition of 300 billion private sector debt, 300 billion worth of private sector debt, will generate annual interest income that will be remitted to the national governments, thereby reducing fiscal deficits every year in the future. So that's it. Quantitative easing is debt cancellation. It's free money. We should take advantage of it. We would be very foolish not to. Next time, I plan to discuss the steps central banks could take to stop inflation if that threat were to reemerge, and also how the Fed plans to go about increasing interest rates when that time eventually comes.